Welcome back, class. This video is going to cover Chapter 11 and then also Chapter 12 in the book. In Chapter 11, we talk about decentralization in organizations, return on investment, and responsibility accounting. And I'm going to go over this, just some of the material that we've already covered, but and as a refresher, but just to talk about what it is. And then I'm going to go directly into Chapter 12. So these two will be combined into one video because Chapter 11 is fairly short and it's uh, it's very brief in comparison to some of the other chapters we've covered. So in Chapter 11, we talk about decentralizing organizations, which means really not that they're not organized, but that they are organized in ways to make managers more accountable for what they do. So when you decentralize, what you're doing is you're creating these things called responsibility centers. Um, and then basically the managers who run these centers are responsible for things like costs, if it's a cost center, um, profit, if it's a revenue and cost center. It's be a profit center if they manage both revenue and costs. If they manage revenues, costs, and investments, then it would be an investment center. And the investments, by the way, are not investments in what we think of as investments, but rather investments in assets that are used in operations. These definitions, by the way, are in the book here on page 509, and I think that would be very helpful to know those. So when we look at a return on investment, which is one of the key measures when you're thinking about performance in any organization, you're going to look at the calculation that we do. We take the net operating income and we divide it by average operating assets. And the operating assets are the assets we use in operations, not necessarily things that we have that we don't use in operations that may be held for investment or future use. So when we're thinking about this, we're going to calculate the net operating income and divide it by average operating assets, and we'll get a percentage as a result of that, and that percentage will be our return on investment. So return on investment can also be understood in another way. We can calculate the margin, which is net operating income divided by sales, and turnover, which is sales divided by average operating assets, and multiply the two together. So that way we can calculate return on investment in another way. And basically this is going to be what I've referred to as the DuPont model. And DuPont, when they were looking at or analyzing return on investment, basically elaborated on the expansion of return on investment into these two subcomponents of margin and turnover as ways to further analyze return on investment. Other than just looking at the percentage itself, you can also look at its components and decide how those components match up to maybe some goals that the company has. So if you really want to see the DuPont model, I handed this out in class. This is this is really a diagram of the DuPont model. So you're going to have the components over here that make up these expenses here. And then these two items are going to make up the net operating income. And when you calculate operating income divided by sales, you get margin. And then further down here, when we look at current assets and non-current assets, we look at what these are. The current assets we know are the ones that are going to be used in a year. Non-current are ones that last longer. We calculate average operating assets from those, and then we take sales divided by those average operating assets to calculate asset turnover. And so DuPont's thing was, okay, we can evaluate this turnover number, we can evaluate this margin number separately, but we also know that those two numbers, when multiplied together, will give us our return on investment. So an example of this, I skipped over it, but it's right here where they actually do calculate the margin and then multiply that times the turnover here. So the margin here is 10% when you calculate net operating income divided by sales. But when you calculate turnover, it's a factor of 2, because you take sales divided by average operating assets. Multiplying those together gives you an ROI of 20%, which is a pretty good return on investment. And then they show a different calculation here based on a different scenario. All right, so that is return on investment. Basically, you just need to know what it is and how you calculate it. There are problems with return on investment, main one being that managers may not know how to increase ROI in alignment with the company's strategic plan. And therefore, they may do things to increase ROI, but it doesn't necessarily help the strategic plan of the company. What they identify here in these comments is ROI is best used as a part of a balanced scorecard, meaning that there are other measures of performance that are applied and evaluated besides just the return on investment. And also, one of the other criticisms here is that a manager can take over a segment and basically inherit many things that they did not actually make the decision to proceed with, like costs or revenues and things like that. And they may either get credit for what a prior manager did or be blamed for what a prior manager did. That can be a problem. Another measure of performance is residual income, and residual income is just taking the net operating income and subtracting from it the minimum required rate of return on assets multiplied by the average operating assets. So we're going to calculate what this minimum required rate of return is in dollars and then subtract it from net operating income. That measurement, by the way, is actually a comparison against what we have as net operating income. When we do ROI, we're strictly looking at what our net operating income is. This measure will tell us whether we exceed or do not exceed the minimum required rate of return that's been established by the company. There are other measures as well, and there are some here subsequent in the chapter. But really, the main focus that I want you to think about here is return on investment and residual income. Those are really two very important ways of measuring accountability in a non-centralized organization. These others can also come into play, and what they are talking about here in the remainder of the chapter is just making sure that you have multiple measures so you can have a balanced scorecard, that you're not just putting all measurements or all performance or accountability based on one particular measure. Okay, I think that pretty much covers chapter 11. Now I'm going to go down here to chapter 12, and we're going to look at decision making in an organization and how we analyze those decisions. So when we understand these, what they call qualitative aspects of decision making, what we're going to do is we're going to look at, okay, what is it that we have to make decisions about? Well, when we're talking about costs, managerial accounting, we need to compare possible scenarios to determine whether or not one avenue that we pursue is better than another. So we want to think about, first of all, that there are two alternatives that we can pursue. We have limited resources, so we want to pursue the best approach that we can. When we look at decision making in this, the way we look at this in a differential analysis is to think about relevant costs and relevant benefits. So we're thinking about, okay, what is relevant and what isn't relevant? Well, basically for this chapter, a relevant cost or relevant benefit is anything that changes as a result of our decision. if it doesn't change because of our decision, then it's really not going to be relevant because the decision doesn't have any impact on it. We're also going to think about differential cost and revenue, which is what I mean by relevant costs and benefits here, because these differential costs and revenue are those things that change. Incremental cost and revenue is anything that changes with the change in the volume of what we're doing. So if we bump up production by 1,000 units, the difference between that increased production and what we had originally is incremental cost and incremental revenue. Avoidable cost is going to be anything that we can eliminate in terms of what we're doing. If we have a cost in the operation that is avoidable, it's a cost that we can eliminate if we choose one alternative over another. And then one thing to keep in mind are these things called sunk costs. Sunk costs are always irrelevant because these costs are going to be there no matter what you do. You basically have a sunk cost if you've paid for some equipment that you're going to use in the process, whether you use it for this one way of doing it or another. That's a sunk cost. It's not going to make any difference. If you have any future costs or benefits that don't differ between decisions, it's irrelevant. And then the last concept that they talk about here is the opportunity cost. Remember, an opportunity cost is not really a cost. It represents the revenue you give up when you pursue a different option. So if you have two options you can pursue, but one option means you surrender the revenue for a particular line of business, then that revenue given up is going to be opportunity cost. Okay, they go through an example here of identifying relevant costs and benefits, and I think we've done this before, but basically what you're looking for are those costs that change with your decision. And so what I would like to do here with this is kind of talk about how we make decisions with different approaches. What kind of decisions are we going to make? So one of the biggest decisions many companies make is whether they add or drop product lines or other segments of business. When you're doing this, you're looking at, okay, what does that product line contribute to our business in terms of the contribution margin, and what are we giving up when we surrender that product line, and then basically what will we gain in terms of other products that we're going to pick up after we drop that line of business. Here's product lines that they show, like drugs, cosmetics, and housewares. And in this example, they're looking at the housewares line, and they're thinking, okay, well, we've got a loss in housewares. What are we giving up if we give up housewares? Well, they actually are giving up this contribution margin of $20,000 here. And will they be able to make up that contribution margin with other sales in other areas once they give up that line of business? So in this analysis, they look at, okay, what's not avoidable and what is avoidable. So the not avoidable costs are $13,000, and the avoidable costs add up to $15,000. So if we're looking at that and we compare that to the contribution margin, well, we're going to save those avoidable costs of $15,000, but we're also giving up the contribution margin of $20,000, which means this is a net loss to us of $5,000. But we're giving up a financial benefit of $5,000. So this is a disadvantage if we drop that product line. And you can see what would happen to the financial statements here if we did drop that product line. If we drop housewares, we're in the hole by $13,000. If we keep it, we have a loss of $8,000, but we're not as far into a loss as we would be without housewares because the contribution margin helps. All right, then there are other decisions we make that are make or buy decisions. So If you're in a manufacturing environment, you may be looking at some pieces or parts that you manufacture. Is it better for you than manufacturing those to go out and purchase those? So if you're going to do a make or buy decision, you're basically looking at the components that you have when you make the product and what kind of direct materials, labor, overhead, supervisor salary, depreciation, any allocated general overhead that you have. You're going to look at that kind of cost to make that decision. So here's an example. They decide whether or not to make or buy these products. And so we have direct materials, direct labor, overhead, supervisor salary, and so on. We have $112,000 in costs associated with making these products. And then if we give it up and buy them, that's going to cost us $152,000. So what we have, we're talking about making gear shifters. What we have is a financial advantage to making these gear shifters rather than buying them, because we actually save $40,000 in cost that we would otherwise spend if we purchased them. And I mentioned opportunity cost earlier, and the opportunity cost, if you give up a product line or if you give up a certain process or item, you may have some opportunity costs that you give up. And here, when they decide to purchase these items, they're going to calculate the cost of making them, but they're going to look at opportunity costs associated with giving up a potential new product line. So let's say instead of making the gear shifters, we could make a new product line and have a contribution margin of $60,000. Well, now that becomes a part of the comparison. When we add that in, we see it's actually an advantage, a financial advantage, to buy the shifters and then focus our energies on this new product line that we were talking about. And the other thing is whether we accept a special order or not. This is another kind of decision that we're going to make. So if somebody approaches us and says, I'll pay you X dollars for this particular special order, you have to be able to compare that and say, okay, well, what are my costs and what am I going to earn on this? What kind of contribution margin will I have? And what is the financial advantage or disadvantage? So you see that comparison here with a special order. And then volume trade-off decisions. And this is one where you have limited capacity and resources. And this is what we were talking about when we talked about resource limitations. When you get into resource limitations, you start thinking about volume trade-offs. Or how do you expand those resources so that you can actually improve the process or the amount of work that you could get through in a particular period of time? Or those resource limitations or constrained resources. So when we look at constrained resources, those are going to limit how much production or how much volume we put through, and in turn how much income we make. And then in this segment they talk about how do you adjust for that. Well, maybe you actually look at ways that you can improve the processing of that particular machine or unit or whatever. Are there improvements you can make to it to increase that volume? If not, then you're going to do a comparison like this to decide, okay, well, what do I emphasize here? What product do I emphasize or prioritize with this particular resource constraint? And they do this comparison and come up with a comparison between the contribution margin, and you can see that in this contribution margin, the Touring Pannier is actually a higher contribution margin and may actually be the better choice. Anyway, in chapter 12, I think that really, oh, one more thing, joint products. I almost didn't talk about this. When we talk about joint products, we're talking about products that we make together, and there's a split off point. We have these different products that are identifiable at a certain point in the process. And the example we used in class was oil, and how you have multiple products represented in the oil that you're processing, gasoline. You may have some other oil products, oil-based products, petroleum-based products that come out of that as well. And so when you start going through those processes, you find out, okay, well, at a certain point, they're separately identifiable, and at that point, we split these off. And then you analyze whether or not it's more profitable to continue the process in a separate product as separate products, or just to sell them outright at the split off point. They do some of that analysis here. So here's an example with wool. They have a separation process. The cost for the wool, that's a joint cost. The separation process is a joint cost. And then they split these different kinds of wool out, and they have the cost associated with them here. The undyed coarse wool, and then the undyed fine wool, and the undyed superfine wool. And they're going to ask, do we continue to process these products? And if they do, this is the cost that they're going to incur. And then basically, when they get done, the final sales value will be shown here. By the way, when we're looking at these costs that are joint costs, we're going to allocate joint costs based on the final sales value of the products. So if we have this sales value here, or well, this is not sales value. Well, anyway, it looks like it would be sales value here. So in other words, it may not pay to continue to process the coarse wool because we have 120,000 in it here, an additional 50,000, but we sell it for 160. Here it's clear that we have 150 and 60,000 in this, but we can sell it for 240, so that makes perfect sense to process it. And again, those decisions will be made at the split off point to decide what you're going to do at that given point. So anyway, these are the areas in chapter 12 that you will want to look at. If you have any questions about these, please let me know. But here is chapter 11 and 12 in this video.